Welcome, everybody, to Ask Me Anything Happy Hour, where we're here to answer your questions, bring the knowledge to you. So,
what kind of questions we got?
All right, we got a few. I love how Matt started his question was like, disclaimer, you're not CPAs, blah, blah, not tax advice. Now, if I can take a policy loan out at 5% to private lend on PMC or something for 15%, is that 15% taxable income, or is it 15 minus 5 equals 10?
Yeah. Can I take this one? I get this all the time. And actually, for my folks who are coming to California, I have like a different presentation that I'll be doing for, it's actually a group of real estate investors. And it's really showing, all right, option A, if I use cash to fund my investments versus if I use my policy, where am I going to be at in the end? So maybe we'll get that recorded. We'll see. But California people, Southern California, I'll be out there doing that. But the rules for it, y'all, anything that you're doing outside the policy is going to be taxed as ordinary income. The tax benefits that come with the policy is the growth that's happening inside of it. All of the growth is tax free. So when we get to that point that we're pulling out more than what we put into the policy, that's tax free dollars to us. But everything outside of it is going to be taxed as ordinary income. So that's where, you get into other tax strategies with maybe trust and different things. And you work with a good CPA to minimize that tax liability. But Matt, to answer your question, it's going to be that 15% as taxable income.
Yeah, you know what? I kind of want to add one thing to that. I think Chris, he stepped away, but he says that sometimes when you're paying tax, you're making money, right? So I don't want you to ever be afraid of making more money, right? So don't ever let the thought of paying taxes hinder you from going out there and getting more. I started John Azraff's kind of winning the game at money. And one of his, he always listens to these things. And one of them is I'm going to write the biggest tax check to the IRS this year because I just made so much money. You know what I mean? Stuff like that. So I don't know. That's just my 2 cents on not being afraid of making more and paying.
Larry Steinhaus says that a lot. If Larry's in the house, shout out Larry. But he asked the question one time when he was teaching, and he says, hey, if I ask you how much taxes do you want to pay, most of the time people say 0. But Larry says, I want to pay as much tax as possible because that just means that I'm making more and more money. Obviously we want to try to minimize the tax liability, right. But that is you're making more.
Happy to say we've got BYOB kids shirts in now. Say,
nice.
Be your own bank, Viv.
Hi, Vivi.
Hey, Vivi.
See you.
Don't touch the screen with those Lay's potato chips hands.
One thing that I wanted to bring up about tax brackets. When you make more money, you go into the next tax bracket. But people think that all of their money that they have to pay on that tax bracket, which isn't true. So let's just say, fake numbers, but if the tax bracket for 15% goes up to $50,000, and then the next tax bracket is 20% up to $200,000. If you make $175,000, you're not paying 25% on everything. You're only paying that much on this bracket and that much on that bracket. You're not going all the way over and around. So people don't really understand that sometimes.
And coming back to compliance, we are not CPAs or tax professionals. Go talk to one.
That's right. I actually find this one interesting that just kind of popped in right now, so I'm just going to skip to that. But Pamela is saying, is the IBC policy considered an asset towards Medicaid qualifications?
Yes.
I would guess yes.
It is. Yep. You can't get around that Medicaid. It used to not be, but then they did start counting cash value toward that. Unless it's owned within a trust and past the look back period, then yeah, it is.
Oh, and then just a shout out to Damian Robinson. He said, anyway, I made more people interested in the infinite banking concept and they are watching videos. So thank you, Damian.
And everyone say hi to Damian. He's serving our country. So we appreciate you, sir.
Awesome. And then I know, Hannah, you were talking about having good meals. Dexter saying come back, for more sushi. Earlier this year, me, Hannah, and Dexter were able to go to Francis's sushi restaurant. So yeah, any restaurant owners, raise your hands. Honestly, I don't have any more questions at the moment, just really nice comments from everybody. Actually, if you want to go into it, Chris, Judy saying, I'd love to see the financial breakdown on the car again. I don't know if you have just rough idea of how you mapped that out. I know your rough numbers of what you You got it?
I don't have the numbers on me. I mean, the car was bought, and then I had called prior to the auction ending. I had called the credit union that I bank at, and I just asked them, what are car loans going for? And 7.25 if you have decent credit, like around a 7, I think it was like 730 to 800 was like 725. I just picked a 5-year term because when you're the bank, you make the rules. Did a 5-year term. Steven, do you remember what the payment was? It was like $2,600 a month or something like that.
Yeah, it was right at $2,600 a month.
$2,600. We'll just call it that. And then what I did is I said, and remember, in order to do this, I would have had to have had the money in the policy's cash value to buy the car. So, I took the loan from the policy cash value and I ran the policy cash value loan at 525, which is actually higher than what some of the insurance companies we work with are at, but I just went with the high number. At 525, the monthly payment to the insurance company, if you were to calculate it monthly. Now, insurance companies only charge interest one time a year, but it was $568, if memory serves me correct, to the insurance company. So if my payment's $2,600, the payment to the insurance company is $568. So just to kind of give you there's a spread. Now, every month I make a payment back to my policy for $2,600, which is exactly the amount the bank would have charged me on that loan. By doing that, though, every $2,600 payment I make back to the policy is money I keep. So we've made one spread, but we all know that the policy is growing uninterrupted. So let's just say my policies, it's a blend because it's all the policies together, but let's say it's 5.6% dividend crediting rate. Then as I'm paying the loan back to the insurance company, remember the insurance company is charging me $525 on the outstanding loan. So if in 1 year, I pay the insurance company back $30-some thousand, which is the $2,600 times 12. Now, the next year, the insurance company isn't charging me interest at $525 on 130. They're charging me interest on $98,000, give or take. So that's a lot lower interest. When I calculated it, it was 3.99% APR that I gave to the insurance company year 2. Year 3 is less. Year 4 is less. So as you're paying the loan down, the balance is going down. Just like like Brent Kessler teaches and our 90-minute teaches, one is going up, your cash value, uninterrupted compounding interest. One is going down, the loan balance to the insurance company, meaning they're charging the same interest on a lower balance, meaning you're actually effectively paying less. So spread number 2 keeps going up. You keep making more money every month because every month you're paying the loan down, but you lose no liquidity of your money. Your money, the $2,600, you haven't lost any liquidity of that. The full 130 is still in my policy earning interest and dividends. Like why people don't see this as a viable way to buy cars is beyond me. The only thing that people ever say about this is they say, well, I had the cash. Why would I make payments, on money that I already had? Okay. Why wouldn't you? If you don't lose anything, why wouldn't you? And they're always like, well, I don't want to pay the insurance company interest. But the insurance company is paying me interest and dividends at a higher velocity than what they're charging me. So does that really matter? So that was the numbers.
Yeah, you're a partner in that mutually owned company. Why wouldn't you want to pay
Oh,
back?
yeah. Well, hey, there's always those buy term invest the difference people that say that's the only way you should do things. Oh, and then there's the IUL people. Don't even get me started. Me and Hannah heard more about IULs and IUL versus whole life on our trip out to Colorado than I think I've heard at any one event. It was interesting.
Yeah.
Hold on real quick. Dexter is saying, can we contact our money mentor and they can let me know how much more I can put in my policy without doing a Mech? Doing that accelerates the policy, right? So go back to their money mentor.
Yeah, your implementation specialist is going to be the direct person, Dexter. And it's a simple question. You're just going to ask, you're going to write an email and say, how much additional PUA can I put into policy, put your policy number in the month that you're wanting to do it without it causing a Mech. And then they'll help send that to the right person. They'll run all the numbers and they'll come back and tell you an exact number. So.
And thanks, Dexter, because I'm coming up on an annual policy next month and I've never done that. So you inspired me to kind of ask that same question. So I'll find out what that is for me.
I always do. I pay my premiums, and as soon as that processes, I send an email to the carrier and I say, hey, how much extra PUA premium can I make without meching it? Because somebody asked me today, how can I maximize this or push it more efficiently? I mean, yeah, the policies are efficient, but keep capitalizing it. Keep maxing out those paid up edition premiums.
You don't have to wait, and that's awesome that you do that, Hannah. You don't have to wait for it to be an annual thing either. You can ask monthly because it's going to change every month. right? The policy is growing daily. So that number is going to actually change every month. So you can check back every month if you want to put more in. I have a guy who just did a 70-30 policy, like 50,000 a year, and he's already put an additional $23,000 of paid up additions back into that same policy. Because like once they're in force, you can actually put more in. So you can just check.
Love it. And Lucy said my implementation, sorry, Jason, my implementation specialist even sent that email for me. Simple process, says Lucy.
And that's the best part, because knowledge is not powerful unless you apply it. And that's why we have the implementation specialist there to make sure you know how to do the things with your policy. And of course, the mentors are always there to guide you. Big picture, long-term thinking, right?
No other questions besides this one, which I did look up this guy. So Navigate Your Venture says, keeping it light, just an observation, is Matt Pittman from Meat Church, the meat-eating distant cousin of Chris Noggle. And I looked him up, Chris, and I think it's because he wears the hat. I don't know, you have to let me know if this is what you're thinking, but he wears a hat and he's got this little kind of like hair that you do that like, I know you call it the mullet hanging out of your hat sometimes. That's what that guy looks like. Hold on, let me see if I can share my screen.
Yeah. Let's see what Matt Pittman looks like.
No, I can't share my screen for some reason, so I don't know how, but it's funny.
No
I wonder
more
why you
questions.
can't share your screen.
It might be my actual Mac settings. I don't know that it's necessarily
Meat Church.
StreamYard. I don't know that I gave it permission. I don't feel like messing with that right now.
Meat Church. I don't know. Here, I'll show you.
It's just the hair and the hat, I think. And you both are kind of short.
Nah.
I just went on Google and there was like more where he had like this little
He looks
hair.
like Michael J. Fox.
He does.
Huh. Oh, there you go.
There you
With
go.
the hair. Okay.
There you go. I see that one.
Interesting. All right. Well, maybe. How do I stop?
Okay, cool. So Emma, do you have any tips for someone trying to bring the gap from losing everything to regaining some functionality? Great
Ooh.
question.
That's a great question. That just came up with the client I had a call with yesterday, which I can actually talk about here in a little bit. And the reason why I bring this one up is that infinite banking is not always a fit. Like that's part of our job as agents and mentors is to make sure that it is a fit, because if it's not, then you are going to get in trouble and unfortunate things can happen. And so I've come across some clients recently where something did happen to it. Another agent did something with a client and they imploded their policies. It didn't work and it never should have been done. So if you've lost everything and you're trying to regain some functionality, it really depends on a lot of factors. How old you are, what are you doing? You know, what are the factors around you? What are the resources that you have available? I would recommend scheduling a call with one of our mentors to help you dive into that a bit more, because it's not just a simple answer to that one. But I'll go through this client here in a moment. But if anybody else wants to respond to that one, it's a great question, because I mean, unfortunately, some people have some things happen and you got to start over. So
Well, we hear a lot about that out in, me and Hannah were out in Colorado, and there was a speaker who gave first speaker of the event gave a really heartfelt message. His name is Mike. Mike, right? That was his name, Hannah? Yeah, Mike. And he gave me a book to read on the way home. Now, the book was his story, but told in third person. And basically, the guy had the world by the balls, if you will. Sorry to put it that way, but he was doing great, worth about $12 million, and then lost it all. Literally lost it all. Didn't just lose everything of his, lost everything of his wife's, everything. They had to sell their house. They had to sell their cars. They had to literally live. He had to save his marriage. Like in that book, it explains what he did to go from losing everything and literally putting a gun in his mouth, because that was the thought he had, is I'll just end it and my family will get the death benefit, which actually they wouldn't have, because that's suicide. It was all mindset. I think the biggest thing when people lose everything is it's a mindset. You need to get into, and it's very hard. I've been at the bottom too. It's very hard, but you got to get into a positive mindset, and you got to believe it's possible, and you got to start just working toward it. It's a slow climb out, and it's going to be work, and it's going to take you really talking to yourself every day and confirming that you are you're doing it, you're making it. So I think more of it's mindset. I mean, there are some other like tactical things you can do and strategies you can do, but that I think is the first step. You got to get your mindset right.
yeah, like what's the thing I always talk about in the Wednesday or the webinars? 3 things you control: money, time, and mind. Mind is the first one. If you don't control that, you can't control money and time very easily. And so I'll kind of share this client story. It kind of tags onto this one, but this is a client where they wanted to do infinite banking. They've lost everything, but then they had some windfalls. So they actually got some money back. They had a few $100,000 come in. they have, what is it called, an IRA that was gifted to them. They got it out of an estate, and they're trying to do infinite banking, but they don't have the income, and their mindset is not where it needs to be to do infinite banking. So I told them on the call that I don't think infinite banking is a fit, because your situation, it's not going to help you. In fact, it's going to burden you, and I'm not going to let you burden yourself. And her mindset was very toxic and very kind of in a wrong place right now too. And I could tell that, because that's something I like to teach. But she was not in the right place. So it's my responsibility to tell her, hey, this is not a fit. But at the same time, what are some other options? And so we walked through, and she was initially very upset on the call, because she's like, I want this to work. But then when we went through the other options, she kind of started getting like the understanding that this is a lot better over here. But the person didn't have the income to really use infinite banking correctly. And so, Christopher, this is one we hear about quite a bit. They want to go buy a home. Not an asset, not a cash flow investment, but a home. And if you use infinite banking for that, what you're doing is, it's fine to do that, but you've got to understand the cash flow. It's very different, because she's going to have a premium on her policy and also a loan payback for her policy loan. Her cash flow would not support that. So, but she has a bunch of cash. So it's a very different situation. But yeah, anyways, to sum that up, is it's not always a fit.
Yeah. Pam, I do want to mention though, like Chris said, the mindset, definitely. And I would say stick around. And the fact that you're even here and commenting is just proof that you have the right mindset, because some people lose it all and they're thinking other things and they're looking other places than where you're looking right now. And so if you found here, I think that's great, and stay with us.
Yeah. I don't have anything to add. No, that was perfect. I think people just even starting to ask questions instead of accepting the defeat. I mean, you're just taking the first step of creating something beautiful and magical for you to continue on living a better life that you deserve. I mean, people deserve to have freedom here. I mean, hello, 4th of July. But, as Jason always says, it's a pain of discipline or the pain of regret. So, I mean, just keep sticking towards that pain of the discipline.
Hannah remembers that every time she goes to the gym, because she texts me.
That's it.
I just put that one from Casual Credit Gaming back up there, because I think this is kind of a continuation of that question earlier about, where we can't give tax advice. But I can tell you a couple of things. I can't give you advice, but I can tell you like what I did. So with private lending, I lend money from an entity. Okay. So when I lend from one of my LLCs. And what I do is I take a loan from my personal policy and I lend that money to that LLC. That LLC, through a documented note that is signed by me, okay, the lender, and the borrower, the entity, both same person, but different. One's the member of the company, one's just an individual owning a policy. I lend the money to the company. The company then makes interest payments back to me. Okay, you could match this to the loan interest rate the insurance company is charging. You can pick any interest you want. When that company writes a check back to me, that interest is a write-off to the company. Okay, so even though me personally, I can't write that interest off that the insurance company charges on the loan, my company can write the interest off if it pays it back to me. So you don't need to be really smart or logical to kind of see how that could benefit what you're saying, because you're making it seem like, I'm not going to do it from my policy because that makes a huge difference. It doesn't make any difference at all, really, because if you were to lend money from a checking account, that income, that interest that you earn from lending that money is taxed at an ordinary income tax because it's short term. Okay. So whether or not the money comes from your policy or from your checking account, I don't understand where the big difference would be. But if you're always trying to get ahead and beat the tax man, you're probably doing it wrong. You're going to pay taxes. There are ways to mitigate taxes, but you got to do it the proper channels. And a lot of that is getting a good CPA that understands what I just explained to you, that understands how to take write-offs in the company name. And that company, if done properly, an LLC, a partnership, can flow through to you. So let's just say that company actually loses money because of all those expenses it has. Those losses flow through to you personally. And if you had any gains on your personal side, they got to be then that would offset. So get a good CPA. We're not giving tax advice, but I did want to hit that because I think you're putting the emphasis in all the decision on the wrong thing, because it says right there, it makes a big difference. It doesn't make a difference.
Yeah, actually, again, not giving tax advice, and this is just me personally, so if you're asking those questions, I assume you've never given a loan, maybe because you're contemplating what the effect of interest income is going to do to you. So I'm just going to kind of talk to you like you've never done a loan yet and you just work and you earn your money the W-2 way. That's how I was until I started lending money. So then I got an LLC. And at that point, the first time in my life, I could write off my cell phone or half of my cell phone bill. So like, regardless of, there's so many more things that I could do. I don't even know, started to pay my daughter something, like things like that. There's so many more things you can do by even just doing your first loan as a private lender. Okay. So to these policy questions a little bit earlier, kind of like what Brian was saying with his one client, is your videos mention about the minimum payment is 10 times your age. Is that monthly or annually?
It's monthly. And I would say that our two favorite words here on this show is it depends. Like, what are you trying to solve? Like, I talked to a client, I'm going to give like a really extreme just to make a point. So I talked to a client, he had talked to some other agent that was designing his infinite banking strategy. And he got on the call with me, and this gentleman was making about $250,000 a year. He was $300,000 in debt. He was 36 years old. Okay, 36. And he's like, look, I just have to pay $360 a month. And this is going to solve, I'm like, it's going to solve your debt problem. How? Like, let's do 360. We'll make it 400, right? So it's easy math. Times 12, that's $4,800. Over 10 years, that's $48,000. You're $300,000 in debt. Tell me how that policy is going to help you recapture and recycle your money. So when we have these conversations in our strategy sessions, it's really about like, what are we trying to solve? Yeah, maybe we can't solve all the debt at once, but what debt are we going to focus on? So you can learn the process of moving your money to recapture that interest that you're paying out to the banks. And then you will slowly, right? You will slowly recapture all that. So it is 10 times your age, unless you're over 60. That's what we say to make it work, but it has to solve your problem or it won't work. That's my opinion. How about Hannah? What's she think?
Yeah, no, I say, I mean, at the end of the day, it's just solving your problems and what's going on. And not everybody even has money problems. And the money problem could just be, oh, where am I storing the money at? That could be a money problem. You 401k people, stock people, you know. But I think really what it comes down to is what is that need? What are our goals that we're trying to accomplish? And then reverse it to, okay, then where do I need to start? And sometimes maybe right now is not a good time to start with this, because actually, Pamela, I want to get to you next. I see your thing in the comment there. But minimum, right? When people ask us what is the minimum to start a policy, 10 times the age on a monthly premium. So if you're 50 years old, $500 a month would be my recommended minimum. Now, you know, there has been some policies that, Hannah, well, I just can't even do 500, but I want to start this. Can I just even start it, not do 10 times the age? And there's some ways that we can work around it just in those specific scenarios. So my biggest advice is I think just get in contact with the mentor and just walk through the questions and the strategies. And it may just not be a one simple Zoom call or phone call that y'all are on doing. It may take some time to get to that point where you're moving forward with your application process. I don't know. I guess that's my thoughts as of right now.
Yeah. And what comment by Pam did you see? Sorry.
Yeah. So it's right under Adolphi. I'm going to butcher it. I fail grammar.
Oh, wait, this one?
Yes.
I would love to discuss this. We are 54 and 63, just exited bankruptcy, you know, including the loss of our home, retirement, and life insurance policy. We're starting over and ready to do so. We don't have a large shovel at this point, nor a lot of time to rebuild. I'm a little lost to how to move forward. I need a mentor who knows more than I.
Yeah, here's my advice there. I would say number one, actively of what you could do, start tracking everything. I hoot and holler about this app all the time on my podcast show, Rocket Money. I pay them $5 a month and they track all of my spending, where the money's going. So we need to know, we need to identify how the money is flowing in and out of our families. And then I would say, so track it, definitely track it. I just like Rocket Money because it's all automated. I don't have to go in there into like a spreadsheet, collect all my credit card statements and everything, and then manually enter it in. But then my second thing is what I would tell you is start paying yourself first. That's one thing my dad has always taught me is rule number one is you pay yourself first. Because I don't even know y'all, but I know how you handle the money. You get the money that comes in, and then you pay everybody else first. The house people, the car people, Bobby's soccer practice, Susie's piano lessons. You just hope and wait that there's more left over for you. You got to change that mindset, and you got to start treating yourself as your number one asset. And sometimes it may take cutting down the Starbucks trip for a snoggle or a snoggle. Just kidding, just put it on blast. But you know, pay yourself first. So you know, our laws of wealth is we should be saving at least 10% of our income. So if I'm getting paid bi-weekly X amount of dollars, try to save 10%. And what I would do is when you get paid into that main checking account, just move that money into a separate, segregated checking account, out of sight, out of mind. So and it doesn't have to be 10%. Maybe 10% is not even feasible right now, but just do some of it. Maybe it's only $25 every 2 weeks that you're moving over there. But just start slow and start where you're at right now and start paying yourself first. And then once we get to that point, you're accustomed to paying yourself first. Then that's the money that we take. And now we start storing it into the policy as those ongoing premium deposits.
You'd be happy to know, Hannah, that Larissa is no longer drinking Starbucks. She found an instant coffee and a creamer she really liked. So she's drinking coffee herself. She even got her favorite mug. And I've only, since now she's not going to Starbucks, I'm not getting Starbucks. So I just had Shauna order an espresso. And I just drink coffee at the office every day. So way to go. I'm saving bucks to pay for Porsches.
That's it. I'm just like you.
Starbucks is so expensive.
Stupid expensive.
All right.
What else do we got?
There's a couple. If you want to, fill up the rest of the show, there's a couple IUL comments. Let's get Chris going.
I saw those.
I intentionally ignored those because I am just sick of it and I need a break from IUL nonsense jargon.
See, we already filled up like a minute and a half of time. Like they
got questions.
Well, actually, shout out, go to Chris Noggle's YouTube channel, literally put in the search icon IUL, just go watch all of that stuff. Or I'll even shout out our close friend and colleague, Chris Kirkpatrick, go to his YouTube channel, Life 180. And then once you see all of that stuff, if you really think IULs are the perfect, most best vehicle out there, we're not the right people for you.
Agreed.
However,
I can say is not, so you know who your client is.
Well, and no disrespect to the people who have them in place, because they didn't know what they know now. So,
Well, do you trust the IRS? If the answer is yes, then put your money to an IUL.
You trust yourself.
If you want the insurance company to put all the risk on you, then an IUL is a great choice. If you want the insurance company to take on all the risk for you, then anyway, keep going.
Well, there's an analogy I use with the 401k and in the IUL that really flips people on the other side of the fence. It's pretty fun.
Okay, so this person says, "What if I put $26,000 a year at $1,000 every 2 weeks and borrowed $1,800 a month for $21,600? Would this make a Mech? Please let me know." Thanks.
Not at all. It has nothing to do with the Mech.
No.
I don't know why you would put $1,000 in every 2 weeks and take $1,800 a month out. I'd want to know what that $1,800 a month is being used for, because it should only be used to go out and make you more money. I think watching the video, the 90-minute video, would help put context to what you're asking, and then book a call with a money mentor to kind of flush out this question. It's a good question, but it doesn't have anything to do with a Mech. That would not Mech your policy, at least how you're saying it.
Another thought on this one: if he's looking to take that much out are we paying our expenses with this? Is this our we're not running all of our income. This is where the one thing we're changing is, where does our surplus money go? Yes. Where does our savings, where does our lazy money? This is not what we're running all of our income in until you have built a big enough warehouse that you're able to do that later on, right? That you can do that later on, like maybe 4 years, 7 years, 10 years, however long it takes you to build your system. I think it's a point people get confused on, because we talk about it because that's a long-term thinking part of infinite banking, is eventually you want all your money running through the system, but they don't connect. The dots aren't connected from when you start your first policy and you get approved up to 20 to 25% of what you earn to be able to put in, until you go out to you've had enough time to build that warehouse where you can run all your income through it. And then you're like Joe does the gas. Joe, you told me that gas gas story, you know, where we're both filling up and we're both paying with our $100 bills, and you're like, whose $100 bill you're paying with? I'm like, dude, you're pulling out of your wallet too. I didn't understand that you were spending the interest that you were making until like the fifth or sixth time I heard it, just to let people know, like, we really dilute, distort, and delete everything we hear, and we only hear what we want to hear. And so sometimes it takes hearing the stuff again and again and again. I know some of us get bored of saying, hey, we're only changing one thing. How many times you say that and you're thinking, okay, come on, what is that one thing? Everybody grasp that. Just where does your money go first? Where does your surplus money go? I talked to someone the other day that literally told me, Chris, did not say that. He didn't mention this. He didn't. And I'm like, yes, he did. You just weren't.
Wait. She said that I didn't mention what?
Oh, we're talking about like this. This is where your surplus money goes, and then other, you know, just other things that are said during the presentation. But again, we always talk about how people hear what they want to hear because it solves their problem and the way they're thinking about it. But it takes a little bit more time sometimes just to hear it a little differently, to receive it differently. That's why to stay around the campfire for the couple, I forgot their names. I can scroll up. But for Pamela and, you know, for Pamela, stay around the campfire. Keep around people that are talking abundantly, thinking abundantly, giving you abundant information, and really showing you what the truth is around it. And then you'll have better habits around your money too.
I agree. And Pamela added, you know, I'm about learning. How many people get a do-over me? So that's like, that's exactly the right people for the campfire.
You guys aren't.
That's right.
You guys said you don't have a lot of time. Like, I want to address that. You're not old. Like 54 and 63, these days, I mean, you're maybe going into the end of the third quarter, but you're not at the end of the game. You still have a whole bunch of time left to recreate whatever you want to create.
My grandpa just turned 90.
Yeah, that's half.
You were supposed to wear that hat. That hat was brilliant. So there's a story about, and I just heard it again, so I'm going to share it really quick. There's a story about Edison. Right? Thomas Edison in his 60s, where there was like a 5-alarm fire where his place was burning down, right? And the whole town woke him up because a lot of the town in New Jersey, right, worked for Edison. They came, they grabbed him. He like put on his clothes, went to the fire, and it was like 4 or 5 stories high. It was green, it was purple. He turned to his son and said, go get your mother and your brother. They will never see another fire like this. And that was his reaction to all of his life's research, to tons of IP, intellectual property being burned down, like over, I want to say it was like $100 million in today's money. I might have that number wrong, but it was like $1 million loss. He turned around and made $10 million that next year. Like, how is that for having a reaction to something that's happening and just seeing it as an opportunity, right? So that was amazing. That was from Ryan Holiday's The Obstacle is the Way, that story. So
Yeah. Hey, Jason, actually, that kind of reminds me of the Cardone family. Somebody asked Elena Cardone one time, hey, what would happen if you and Grant lost everything that you have and you guys are just at zero? And Elena said, yeah, well, that would suck, but it's not going to take me as long to accumulate it all back because you can't take away what's up in here.
That's it. That's it. Just keep feeding the best asset that we have, and that's our mind. But here's another, don't do it at the expense of all your finances either, right? Like, I talked to someone today that eventually will be helping them, but they're like, yes, I knew to be in this mastermind was 40 grand. I knew to do this is going to be this much, and investing in myself is going to give us massive returns as a family. But now there's $70,000 in debt, on credit cards. So we want to make sure the first rule of financial literacy is make more than you spend. Make more than you spend. Not the other way around. Like, yes, invest in yourself, but maybe it's not time to do that mastermind unless you know that there's an actual outcome, not just learning, right? So just some thoughts.
I got a couple of rapid fire questions here too.
Good
So Tim is saying, I have some extra money coming in. Can I add it to my policy?
Yeah, just check
Maybe.
with your implementation specialist.
Yeah.
Probably.
See how much extra. Hey, and I see that you're starting down there. Just one more. I'm sorry, I'm going to butcher the name. Mr. Sullivan, you're asking, how do I pay the minimum monthly payment in the policy if the monthly payment is set up automatic? Call the insurance company. All right, they'll change it for you, and get with your implementation specialist. They'll help you with this. This is why they're there. Lean on the team.
I love that. Chris, I'm hoping you can answer this one. So if I already have a policy through another agent, not ready for new ones yet, do you have any suggestions of where to go to learn about the private lending side? I mean, about the business side.
Well, private lending or the business side. I mean, I put YouTube videos up on that all the time. Plus, we have Private Money Club's YouTube channel, which would be good for that kind of stuff. Or you can just go to privatemoneyclub.com, and on there's a whole learn section, totally free. And you can go on there and learn all about that, where we talk about those things that I mentioned earlier, where the LLC and the lending, all that stuff is discussed there. My gosh, I mean, Hannah, I don't know if your podcast talks a little bit about some of your private lending. That might be another good resource.
I have one with Dad.
Yeah,
Dad,
that'd be perfect.
about it.
That'd be really good.
It's called The Art of Private Lending, YouTube and all podcast platforms.
There it is.
Cool. And then, yeah, so not tomorrow because Noah's taking the 4th of July off, I'm assuming. He's not like Jason, but normally on Thursdays, one of our coaches on the Private Money Club has a, like basically the intro to private lending and borrowing every Thursday at 1 o'clock. You can, if you go to privatemoneyclub.com, it's right on there.
I just want to hit this one. Elizabeth, yeah, thank you. I'll make a better point to always make sure I'm talking about the amount you save, not all your income. But I think I try to always, delineate that, but I'll do a better job.
Chris, you do a great job. No bust throw them. Just
well, Elizabeth doesn't think so. So, hey, you can always do a better job.
No, it's good feedback, though. This is what we want to hear.
Feedback.
You know what I always say? Don't tell me all the good stuff. Just tell me all the negative.
Tell me why I
need to
suck.
work on.
I like that about you, Hannah. All right, so Navigate Your Venture saying, is One America more flexible on additional PUA compared to Lafayette? I have policies with each one, and I'm asking so that they can pick, for the third one, which one should go back, they could go back to.
I know One America's policy on PUAs, you can put up to 10 times the base in year 1 and 3 times from years 2 and on. So as far as I'm aware, they're the most flexible of our 5 favorite mutually owned dividend paying whole life companies that we partner with, as far as their flexibility in their PUAs.
Sweet.
But let me add, though, so both of them are the same in the sense that you can always lower it down just to $10 a month or $120 a year to keep the PUA premium attached on. I think it more goes to what are the problems and the goals that we're trying to solve. And too, which company do you I have some families, they say, hey, I just want to stay with this one company because I know them. I understand how they operate. At the end of the day, all the mutually owned companies that we do business with, they're great, great companies.
And just to make clear, Hannah, she was asking about being able or navigate your ventures, was asking about putting additional PUA in and the flexibility there. So everything Hannah said, yes and yes.
Isn't the dump a little bit different with Lafayette than with One America, though?
Yeah.
Yes.
Larger to the ongoing.
More.
You can dump a lot more, 5 times more.
And that's because they'll allow a higher percentage of PUA.
We're talking about after the policy's enforced, Joe.
And then in year 2, you could still put in a dump.
Not with Lafayette.
One America is way more flexible with that, Joe.
Although
You can design it.
yes, you can.
Yeah, you could design it that way, but if it's not designed that way, it's kind of a closed door after year 1. One America is a little bit more flex.
Awesome.
Hey, last thing I want to say before we log off here, to comment on Elizabeth's thing there about, because I get where the question comes from. On page 48 of Nelson Nash's book, he talks about how premium and income should equal, because when we get money that comes in, all of that money has to flow through somebody's bank. We want it to be our bank. But I was having a conversation with our Canadian counterpart, Mr. Jason Lowe, and I was kind of asking him questions about that page because he spent lots of time with Nelson. And I had a big light bulb moment when I was really asking Jason about, well, wouldn't this just be like an ever chasing goal? Because hopefully as time goes on, I'm making more money, my assets are rising, and I have a need to want to keep funneling more and more premium inside of my policies. So wouldn't this just be an ever chasing goal to get to that point of premium to equal income? And he says, no, I get what you're saying, but here's what Nelson's talking about. It's the monies that come out of the policy, the guaranteed income that comes out to sustain and float the cash values to equal your income. And I actually talked about this at the mastermind Chris and I were just at in Denver. But you know, I'm trying to get to a point right now in my prime working years to capitalize as much premium as I possibly can, because then in the future, that cash value is going to be so efficient that I'm going to have this guaranteed income stream that's coming out of the policies that's going to supplement my income. And that's how I'm going to get to my cash values. I feel like this is what Nelson should have said: cash values to equal income of what comes out of the policy. I hope that makes sense.
No, that was kind of a light bulb moment for me. It started to turn on. I gotta turn it on more. I think.
I want to hear that again. That was awesome. And I would say
Yeah.
that could be an awesome episode we do some days, our moments with Nelson. Like I had a similar one. I won't drag it out here and share it today, but I had a similar one where I've read the books at least 7 times fully and parts of it 20, 30 times. And, you know, there was a part that I thought I understood it, and then I heard it a different way. Like Hannah just explained that. And I'm like, oh, that's what he meant? I didn't get that. But I see the power in it. So that'd be a fun episode to see like what we're each thinking, since we talk about it differently. We receive information differently. We have different learning patterns. I think that'd be a cool show.
Agreed.
Awesome. Well, with that being said, folks, it's been an exciting day, and it's going to be a really exciting couple days. So all of you go out there, say thank you to a vet, say thank you to our military, our first responders, and just say thanks for your service. Folks, enjoy Independence Day, and just remember what it is. With that being said, we will see you on the next one.